J.L. Collins, author of the famous stock series that later became one of the best personal finance books ever written, The Simple Path to Wealth, a true FI legend. This is J.L. Collins and why most people lose money in the stock market. Take a look at this chart, which shows the historical relentless rise of the Dow Jones Industrial Average from 1900. Now take a look at this one, showing the UK FTSE All-Share Index inflation-adjusted returns from 1694 to 2008. If we looked at graphs of the S&P 500 or a global index such as the FTSE All-Cap Index, we would see similar results. It's been a roller coaster ride and there has been plenty of drops along the way, but over the long term, the stock market has been a great place to be as a patient long-term buy and hold investor. But despite the stock market's relentless rise over time, most people lose money in the stock market. Here's J.L. Collins' reasons why. Number 1. We panic when times are tough and buy when the market is soaring. We humans are not programmed to psychologically prosper in a volatile market. Humans are hardwired to buy high and sell low, when this is exactly the opposite of what we should be doing. Most investors get returns less than that of the investment funds that they invest in. This is called the behaviour gap and is a result of emotional decisions based on trying to time the market. In the words of Warren Buffett, the Dow started the last century at 66 and ended at 11,400. How could you lose money during a period like that? A lot of people did because they tried to dance in and out. Number 2, we believe we can pick stocks. JL says you can't pick winning stocks. Don't feel bad, I can't either, nor can 80% plus of most pros. Even slightly beating the index year after year is extremely difficult, and only a handful of investors have been able to do it, and doing so made them superstars. Number 3, we believe we can pick winning mutual fund managers. As JL puts it, actively managed stock mutual funds, funds run by professional managers as opposed to index funds, are a huge and highly profitable business. Profitable for the companies that run them, for the investors, not so much. Around 20% of active fund managers will underperform their index over time, and all of them will charge high fees for the privilege. You might think it's easy to navigate by just picking the best funds of the recent past. Every prospectus carries this phrase, past results are not a guarantee of future performance. This is often the most ignored sentence in the whole document, but it is also the most accurate. Number 4, we focus too much on froth and not enough on the beer. JL likens the stock market to a glass of beer, made up of both the beer and the froth or foam that sits on top. The stock market is made up of a combination of these two. The beer is the actual operating businesses that we can own a part of, and the foam is the noise that accompanies the stock market. The daily jumps in share price movements, news reports, stock tips you hear down the pub, etc. It's the foam that people are talking about when they say that investing in stocks is like gambling. This is the part that you need to learn to ignore. Always remember that owning stocks is owning a part of living, dynamic companies, each striving to succeed. Over time, it's the beer that matters, so listen to Uncle JL and kick back and enjoy your beer, with the comfort that it's the money-making underlying great businesses of the world, beneath all that foam, that drives the relentless rise of the markets. When you own a global index fund, you own a tiny piece of most of the publicly traded companies in the world. And over time, technological progress, innovation, and increased productivity should lead to higher future profits of these companies. In the words of legendary investor Peter Lynch, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves.